Well, good evening, everybody. For those of you who haven't met me before, I'm a professional mining engineer by background. I started my career with BHP Billiton in Australia. I was involved in managing coal mine operations. I've also worked in other commodities. In 2004, I moved to London, where I became involved in mining, corporate development and investment banking. And I've worked in investment banking here for 7 years. I became CEO of Prairie Mining 5 years ago. And now let me tell you about our assets. Okay, so we have two Tier 1 coking coal projects with highly favourable regional markets. And these markets contain all of Europe's steelmaking industry, which is currently dependent on imports of coking coal for 85% of its supply. Our two projects, KARSKI and DEBIENSKO, have a combined NPV of over $3.3 billion US dollars, with projected annual EBITDA of $630 million US dollars. And as I said before, it's a fantastic regional market dynamic. Europe consumes over 75 million tonnes of coking coal per year, and 64 million tonnes of that, or 85%, is imported. It's mainly imported from Australia, about 50%, 30% from Russia, and the rest from the USA and Canada. In fact, coking coal is so important for the European steelmaking industry that the European Union has deemed it to be a critical raw material. Critical for European industry, critical for Europe's steelmakers to turn out new electric vehicles and wind turbines and new nuclear power plants. The other aspect of having deposits in the middle of Europe, in the industrial heartland of Europe, is that the transport cost of delivering to the steelworks is minimal. If you look at bringing 1 tonne of coking coal from Australia all the way into central Poland, it will take 59 days and cost about $37 or $38 per tonne. With our projects, we can deliver the same coal in about 24 hours for less than $5 a tonne. So that's a price advantage that our projects will enjoy. So our first project is DEBIENSKO. It's a hard coking coal asset. Our scoping study was published in early 2017, and it showed we can produce 2.6 million tonnes per annum of hard coking coal at less than $50 a tonne cash cost, a pre-tax NPV of $1.5 billion US dollars, a 26-year mine life, and an upfront capital cost of $504 million US dollars. The thing about DEBIENSKO is it was a formerly producing mine. It was closed by the Polish government in 2001. It's been on care and maintenance ever since. That's a picture of the mine today. There's a railway line, there's a shaft. One of those shafts is still active today. You can go underground there. It's fully permitted. We have a 50-year mining concession, and we have all environmental consents in place. So once our geological studies are finished, we can start. There's nothing to stop us from starting to mine here. This is an aerial photograph of the site, and everything within that black line there falls under our mining concession and our environmental consent. And importantly, we have the large tailings facility up there, which is, again, fully permitted. Difficult to do in Europe these days. Here's some more photographs of the DEBIENSKO site. You can see the railway siding there. That exists today. There's rail cars running past there daily. There's the shaft again. That's the winder in the shaft to make the lift go up and down. And there's the office block. Now here's something that's very exciting about DEBIENSKO. Coal is a bulk commodity. And it means when you build a new coal project, you've got to build all the infrastructure associated with taking that to the end user, to the market. And for example, in Australia, that would involve building a new coal mine and 1,000 kilometres of railway line and a new port. We don't have to do any of that in Poland. All the railway line is there. It's left over from communist times. In fact, when we've tallied it all up, for us to bring full rail capacity, road, power and water to full production capacity at DEBIENSKO, it will cost us about $10 million US dollars, which is absolutely de minimis in the world of coal mining. We also have very well understood geology and proven operating history. Not only did DEBIENSKO operate itself up until the year 2001, but you can see here It is surrounded on two sides by mines which currently operate today. These mines are owned by a company called JSW. JSW is listed on the Warsaw Stock Exchange. It has about a $3.5 billion US market cap. And you see these graphics here show cross sections between the JSW mines, which are producing today, and our project DEBIENSKO. You can see the same coal seams, similar geological setting. The steel makers of Europe have been using this coal for over 50 years. They know exactly how good a quality it is. Our second project is called KARSKI-A. That's a semi-soft coking coal asset. So semi-soft coking coal is a little bit inferior product to hard coking coal. It sells in today's market at about $110 per tonne, whereas hard coking coal sells for nearly $250 a tonne. But KARSKI-A is much larger scale. We published our pre-feasibility study in 2016. We predict we can produce 6.3 million tonnes coal per year for just $25 US a tonne. Very, very low cash costs of production. Pre-tax NPV of $1.8 billion US, 24-year initial mine life, and an upfront capex of $632 million US. That's a 3D render design of what the mine site will look like from our pre-feasibility study. Okay, it's quite an advanced project. You see here, that's the concession we have there. The yellow dots are historical boreholes we inherited from the Polish government. The red dots are drill holes we've completed since we've owned the project. It's also proven geology because right next door in the grey here is a mine called Bogdanka. Bogdanka is also listed on the Warsaw Stock Exchange. Bogdanka is the lowest cost, most profitable hard coal mine in Europe today. We know everything about the geology here. We understand how to mine it. It's being done right next door. The infrastructure is mostly in place. We have 15 kilometres to the national railway line down here. We have power lines that come up and surround the project. So it's not going to cost a lot of money to get that infrastructure into place to get the mine into production. The economics of the KARSKI-A project are really unlocked by one particular seam, the 391 seam. That's the red seam there. Our neighbours at Bogdanka, they produce from 4 seams and they produce thermal coal for power stations. And the Polish really didn't understand that beneath here was high-value semi-soft coking coal. And our modern exploration program, the drilling work we've done using international standards, has demonstrated that time and time again. So we have a huge resource of this ultra-low ash high-value product which will go into the steel industry. And that's the differentiator between our project and the mine next door that produces thermal coal. In terms of our financing and development strategy for KARSKI-A, in November 2016 we announced we entered into a financing and construction agreement with a company called China Coal. China Coal are the second largest coal mining company in China, but they're also the most prolific mine construction firm in the world. Now think about that. China's added over 2 billion tonnes of coal mine production capacity in the last 25 years. They've built more coal mines than the rest of the world put together ×3. These guys know how to sink shafts. They know how to get coal out of the ground. In fact, I think they're the best at it in the world today. So the deal with China Coal is they are currently completing a technical study on the KARSKI-A project. We're helping them very much with that, and we're also feeding the latest results from our drilling program into that study. That study will form the basis for Chinese banks to provide a debt funding package for construction of the mine. And in return, we will give the Chinese or China Coal a EPCM contract, engineering, procurement and construction contract to build the KARSKI-A project. So that is our plan for the, over the next 12 months. I mentioned at the start of the presentation that we're in a region of highly favourable demand for coking coal. I just want to put that into context. Here you have Europe's major steelmakers. ThyssenKrupp in Germany here, Voest-Alpine in Austria, US Steel here, and ArcelorMittal, one of the world's biggest steelmakers, with extensive plants all across Poland, Czech and into the Ukraine. Steel plants here indicated by blue dots, coking plants by the red or pink dots, And you can see the rail network. All of these steel plants and coking plants are connected to our projects by existing rail. So that's our major infrastructure advantage. And these are ready off-takers who can potentially also work with us on developing our projects and buying the product. Point being, it's a lot more cost efficient for ArcelorMittal to buy a tonne of coal from us here, 70 kilometres away, than to ship it all the way from Australia, which will take 59 days and cost $38 a tonne. So I want to leave you with a thought. What makes a Tier 1 coking coal project? Tier 1 is another way of saying world class. And to me that means, what are the attributes of a project which would mean another company, a big mining company, wants to come along and buy us or buy our projects? What are the criteria? Sovereign risk. Which country is the asset in? Well, we're in Poland. Compare that to other publicly listed coking coal companies that we're aware of around the world. Tiger's Realm, Russia, Indonesia, South Africa, Mongolia, South Africa. Poland stacks up pretty well, EU member, compared to Mongolia and Indonesia and Russia. High quality product. We've already proven we've got 95% premium hard coking coal at DEBIENSKO and 75% semi-soft coking coal at KARSKI-A. We've done that through the historical drill program and through our modern work. We have globally significant scale. Both mines can produce over 2.5 million tonnes of coal per year, which is sort of the metric that large mining companies apply when they look at acquisitions. We have long mine lives, in excess of 20 years for both assets. And we haven't even begun to exploit all of the resource base yet. We've just drilled out part of these projects. We could easily double production capacity or double the mine life for both of these assets with more exploration work. Our cash costs will be in the first quartile for both projects. DEBIENSKO, we can produce hard coking coal at less than $50 a tonne. Today, hard coking coal sells in the market internationally at around $230 to $240 a tonne. That's a massive margin. Similarly for KARSKI, we can produce there at $25 US a tonne. Today, coking coal selling at $110 US a tonne. Again, high margin projects. Which means we have compelling economics, which is a high NPV to CapEx ratio. Now the last category here is infrastructure. Major infrastructure is in place. This is infrastructure that you don't have to build. It exists today. So if you look down all of these companies here, we're the only company that has projects, 2 projects in fact, that fulfill all of those criteria of being Tier 1 or world class. Thank you.